Following the completion of runway upgrades, Dubai International is expected to remain the world's busiest airport in terms of passenger numbers for at least a decade. According to local reports, the airport had maintained its top position during the first 5 months of the year, and after the completion of the 80-day runway upgrade period, flights at the airport have surged by 31%. As a result of the two newly refurbished runways, the airport is expected to accommodate more aircraft, while improving operational flexibility during peak traffic periods. Dubai International had handled 29.6 million passengers during the first 5 months of the year, while London Heathrow reported 28.47 million passengers for the same period, according to the data released by both the airport's operators. By the end of May 2014, passenger numbers rose by 9.2% at Dubai International, while Heathrow recorded only a 2.2% growth during the same period. The runway upgrades were part of Dubai Airport's $7.8 billion SP 2020 master plan aimed at expanding Dubai International's capacity to help accommodate more than 103 million passengers by 2020. Office rents in Dubai's prime central business districts have witnessed 3% average increase during Q2 2014. That's according to a new report by the global property advisor CBRE. According to the CBRE Middle East Q2 2014 Dubai Market View, average prime central business district rents were up 3% quarter-on-quarter and 25% year-on-year. As per the report, the average prime rental rate now measures 1,884 dirhams per metre squared per annum, and the figure is expected to increase further within the short term due to strong economic growth and rising business confidence. The report further highlighted that occupancy rates within prime CBD offices have been rising steadily over the past 12 months, with less than 16% vacancy rate compared to an average of 40% vacancy for all Dubai office stock. Furthermore, due to the increasing business confidence, office stock in Dubai continues to see significant growth, with over 1.8 million metres squared set to be delivered by 2017. According to CBRE Middle East Head of Research and Consultancy UAE, with limited availability of good quality office spaces, they expect a demand spillover to secondary locations, which have witnessed rental growth of 5% in Q2 2014 and 24% increase year-on-year. The National Bank of Abu Dhabi, the largest lender in the United Arab Emirates, has reported a 17.5% rise in second quarter net profit, beating analysts' estimates. NBAD, almost 70% owned by the Abu Dhabi government, made a net profit of 1.42 billion dirhams in 3 months to June 30, up from 1.21 billion dirhams in the corresponding period of 2013, according to a statement from the bank. Non-interest income rose 20.1% year-on-year to 830 million dirhams in the second quarter, as fees and commissions jumped to 26.8%. The bank booked loan impairments totaling 215 million dirhams, lower than the 301 million dirhams booked in the second quarter last year. Loans and advances grew 4.8% year-on-year to 181.7 billion dirhams, although year-to-date NBAD's lending total was down 1.1%. Deposits stood at 237.4 billion dirhams on June 30, up 8.2% year-on-year and 12.5% year-to-date. And First Gulf Bank matched analyst expectations by reporting a 16% rise in second quarter net profit on Tuesday, with earnings growth propelled by lending income. The second largest lender by market value in the UAE made a net profit of 1.35 billion dirhams for the 3 months to June 30. Earnings growth in the period was boosted by a 12% year-on-year increase in net interest and Islamic financing income, which rose to 1.65 billion dirhams on the back of an improved net interest margin and higher lending. Total lending stood at 128.2 billion dirhams at June 30, up 4% since March 31 and 6% on the same point of 2013. Deposits at June 30 were 137.5 billion dirhams on June 30, up 6% and 11% over the same timeframes. Non-interest income also gained in the second quarter, rising 18% year-on-year to 641 million dirhams on higher contributions from subsidiaries.